What if I told you that the government's latest pension changes could cost your family hundreds of thousands in inheritance tax? If you don't know me, my name's George Agan. I'm a chartered financial planner and I've helped thousands of people retire without worry. And today I'm going to break down exactly what these new changes after the budget mean for you, why they're happening, and most importantly, what you can do about it. More specifically, I'm going to show you why these changes are more significant than they first appear, how they might affect your retirement planning, the new position which could potentially lead to a 67% effective rate of tax, and why some have called that double taxation. And exactly, in my view, what you can consider before 2027 and these changes come about. So just before I go into these rules, I just want to make clear these are proposals which are subject to consultation. So the position could change and any changes aren't due to come in until the start of the tax year in 2027. So it's important not to panic. I do pull apart some of the elements of the proposal later, and part of that is to play devil's advocate a bit. And the government could, in fairness, say that the whole point of the consultation period is so that they can thrash things out. And here's hoping. And it's not finalised legislation yet, so as always, please seek advice specific to you before you do any proper planning. So the key announcement was that from April 2027, most pension funds will suddenly become subject to inheritance tax, a change the government predicts could affect about 38,500 estates each year. But here's what's really interesting. The government's own figures show that this will cost families an average of £34,000 extra in tax. For some families, that could be way above that. So just before I talk about navigating these changes, I need to explain the current position with pension death benefits. As if you don't understand that, then there's just no way you'll understand the implications of these changes. So firstly, there are different types of pension schemes, but there are two broad categories which have slightly different death benefit rules. The first is defined benefit. So that's when you have a guaranteed income for life. And it's a pension promise effectively from your employer, and the value of the pension you have is linked to your salary and your service. The benefit is defined, as the name suggests. Think NHS pension, teachers' pension, and obviously what the MPs get, the Parliamentary Contributory Pension Fund. And I'll come back a little bit later to why that's so noted. So for the defined benefit schemes, these schemes have rules where there's an inbuilt spouse's pension or dependent's pension, maybe for example like a 50% spouse's pension. There can be some lump sums, but in general, the main benefit is dependent to be that guaranteed income for your spouse, civil partner, or a dependent. And that kicks in when you pass away. For these benefits, it's always taxable at the recipient's marginal rate, regardless of when you die. And generally speaking, there isn't anything for your children unless you're unfortunate enough to pass away when they're young. There can be some really rare exceptions. So for example, if you've got a child who has a severe disability and they're still going to be financially interdependent on you over the long term. Also, it does tend to cease when they're either 18 or 23 if in full-time education. But as a general rule, these schemes are not designed to leave any type of legacy. You also don't have any choice about how the scheme operates. It is the rules and that is what it is. So the other type of scheme is a defined contribution pension. That's where you've got a pot of money and in retirement, you have a choice on your retirement options. You can choose to draw down on that money, buy an annuity, a guaranteed income for life. But the key thing is the value of that pot is not guaranteed. All that is defined is the contribution, hence the name. It's what you and your employer put in. If it grows, great. If it doesn't, well, that's your problem. So for the death benefits for a defined contribution option, it does depend on what options your policies have, but it can either be paid as a lump sum, so all in one lump sum, an annuity bought for your beneficiaries or dependents, which is that guaranteed income for life, or to stay in drawdown, where they draw down the benefits however they choose over 1 year or many years. The technical name is nominee and successor drawdown because you can actually cascade the benefits down the generations as long as there's some money left. I just want to be really clear because this is actually quite an important point. While these are all the options through a defined contribution arrangement, they are not always the options that all schemes have. So it's a regular occurrence for me as an advisor that we'll have a look at some of the scheme rules, especially if they're older, and it might be there's only a lump sum available. And that's going to become more and more important going forward, as I explain later. But one of the clear take-homes here is that these flexible pensions were very effective for legacy before 2027 when they're outside the estate for inheritance tax. Because the pension wrapper itself is super tax efficient, there's no capital gains or income tax on any of the growth, and they were being used as something which is maybe spend them last because they offer an excellent legacy option. In fact, the government's own statement says, in recent years, pension schemes have been increasingly used and marketed as a tax planning tool to transfer wealth without an inheritance tax charge rather than for their intended purpose of funding retirement. This has been exacerbated by certain changes in pension tax policy over the past decade. And in fairness, when the Tories abolished the lifetime allowance, what it also did is it kind of brought a bit of a weird position where, let's say someone had a defined contribution pension, as long as it had the right features, even if it was worth, say, £5 million, if they died before 75 and then their beneficiaries allocated it to drawdown, they could then be drawn down entirely tax-free by their beneficiaries. And to be honest, as a professional, when I kind of saw that as a workaround, I was like, really? That's generous. And the government's consultation does note this. It says this means that individuals can accumulate unlimited tax-free savings in their own pension, draw on other means to fund their retirement, and leave their unused pension asset to be inherited by beneficiaries without any inheritance tax charge. That isn't entirely true because, as I'm about to explain, but as a generalization, it did leave scope for that to be a possibility. So one of the main things you need to be aware of is if the death occurs pre or post 75. Because if death occurs after 75 under legislation, it's taxable at the recipient's marginal rate. So potentially 0, 20, 40, 45%, depending on their tax rate at the time. If the only option via a defined contribution scheme is a lump sum, it could be the equivalent of being paid £200,000 all in 1 year, having a huge salary, being taxed as if you had a huge salary, or up to nearly half of it could go to the government as a tax. So when we're talking about pensions being inside the estate, I do have to caveat, and I want to give context because I appreciate quite a few people use these videos for guidance, but not all estates pay inheritance tax. As I've explained in a previous video, and just very briefly, you have a nil rate band of £325,000. If you leave your property to your direct descendants, then there's an additional main residence band of £175,000. Very broadly, you can transfer benefits between your spouse when you pass away. It's called the spousal exemption, so it's generally completely exempt. There can be exceptions, and of course take advice. But your spouse, when they pass away, they also typically would be expected to have their bands. So very high level, there could potentially be £1 million of inheritable estate within exemptions. Anything above that is chargeable at 40% as an inheritance tax charge. So that's quite a lot. Anyway, now with these current proposals, unlike pensions being typically outside the estate under trustee discretionary rules, most pensions will now be in your estate from 2027. But the spousal exemption will still apply. So while the pension is within the estate, your spouse can still claim that exemption if it just goes to them. It's only when it goes to a non-spouse or civil partner or to children or whoever. I also do want to acknowledge that with the whole position with pension tax relief and the theory behind it is that you defer tax or you get tax relief initially as an incentive to save. It then grows tax-free and then you pay tax at some point at the end. So and again, I'm not excusing anything on the government, but I'm just saying the system is set up on the understanding that tax will be due at some point. And that arguably is the distortion that was commented about around the pre-75 rule. So that's an overview of the rules as it is now. Now, under the new consultation, that is all going to change. Pensions are going to be in the estate. So now you know the rules and the context. How does this work in practice? Well, here's where it gets interesting. Under the new rules, pension scheme administrators will coordinate with the personal representatives, the people who are legally required to administer the estate. A calculation will be made at the time about how much inheritance tax is payable. What could go wrong? The pension scheme administrators will then deduct an inheritance tax charge from the pension scheme if applicable to the scheme. So that potential inheritance tax charge is coming from what you could argue is pre-tax money. It's not that you have to take it out of the pension to pay the inheritance tax charge and then pay income tax and then the inheritance tax charge. It's very similar to how the lifetime allowance worked at, for example, at the testing point of age 75. The scheme paid the tax directly. So where you might have heard of the double tax position, so to speak, is similar to what was on the Martin Lewis Money Show and so forth. is what they're referring to is around deaths after age 75. Or potentially if they're above the lump sum allowance. So I'm just going to park that because we're going to get way too technical for the purposes of this video. Let's do a very simple example. And let's just say £100,000 of pension money, which is all subject to 40% inheritance tax. So now that's the pension scheme administrators have taken that 40%, leaving £60,000 in the pension pot, so to speak. Now that would also be subject to the beneficiary's rate of tax. And if it's, for example, just a lump sum only option, and now you're about to see why that lump sum element is really key. And let's say they were already earning good money and we're already at 45% marginal rate. That would actually result in just 33 grand being received by the beneficiary off the initial 100,000, which is an effective rate of tax of 67%. But the 45% rate of income tax is unlikely to apply to many beneficiaries. If you allocate your fund to drawdown and your beneficiary then flexibly draws down as they choose, for example, I've kind of shown a bit of an example here. An example of someone earning 30,270 and then over years taking £20,000 on their pension pot. So as long as the beneficiary knows and gets good advice, which is probably where people are going to get most caught out if they don't have this advice, then there are ways to be tactical to mitigate and reduce this charge. But one of the things that's going to be increasingly more important to do is make sure your schemes have the right features for what you potentially might want. Because if it's just a lump sum and you do pass away after 75, it doesn't matter your beneficiary's preference that the lump sum is the only option available if that's the case. So this is now the fun part of the video that I try and throw in as much as I can, because that's the whole point you're watching this, where I'm going to use my sort of insight as a professional and kind of criticize or highlight any holes that I can see with the current proposals and make clear what I think you might need to watch out for. Just very quickly, if you find this video useful, please do consider subscribing to the channel, as I'm doing quite a few videos after the budgets on strategies I'm going to be using so that we can kind of manage the budget position and what to consider from a planning perspective. Also, if you do like to stay informed, my newsletter, which is linked at the bottom, gives you access to an ebook, 5 pension tax mistakes to avoid, which I need to update, as well as the tactics I'm going to be using with my own clients and a retirement scorecard, so you can see how on track you might be for retirement. I'm also actually building a cash flow model via Excel that I'll be giving away for free to my subscribers. And you can, of course, unsubscribe anytime if it's not valuable and your data's never shared. Okay, so let's get into all of this. So the first real concern I have is in relation to the reporting guidelines and probate, that all the issues this is going to cause. I'll highlight a quick overview article from the FT, which you can actually get access to, but it's really well documented at the moment that there are currently huge issues with getting access to probate and the general estate administration period, with this article saying that the average time for probate granted is about 14 weeks. Now, we're about to add a ton of complexity onto that, and trust me, every single day, one of the biggest professional challenges we face as advisors is getting information from pension scheme administrators. I'm not exaggerating, it takes months. Often information doesn't come back correct. The company I work for, we've got a dedicated team whose sole job is to make sure that information we get is accurate. The resources it takes to get this stuff is no joke. And bear in mind, people often have several pensions accumulated over their lifetime. Normally as an advisor, we can end up sometimes consolidating them if it's the right thing to do. But all of this stuff assumes that all these pension schemes and the personal representatives are going to communicate with themselves in a quick and orderly manner. What is also not well understood is that there is actually a pension death benefit rule underneath the pension death benefit rule. And it's to do with what's called the 2-year rule. If pension benefits are not paid out within 2 years of a death, at the point where administrators could have reasonably known about a death, it's all taxable at an income tax rate, regardless of whether the death occurred pre or post 75. And that's the most obvious case of foreseeable harm I can see with this situation. So having direct experience with this kind of stuff, this has the potential to be a real admin nightmare. And I'm near certain, unless there's something done about it to improve efficiencies, there's going to be epic delays and frustrations for people at, let's be honest, probably quite a challenging time in their life. Now, the proposals do make clear that they're saying pension scheme administrators have 2 months to respond to request. But bear in mind, all parties, the various schemes, the personal representatives will all need to have accurate information. And I speculate that I think this could cause big delays. And even if your estate is actually quite small, that doesn't mean you're not necessarily going to get affected by this. You will have to do the same forms as everyone else, and pension schemes basically have to cover their backside, understandably, And when we add this all together, I can just see more and more people getting a list of forms they've got no idea how to complete. None of this is to say it's not resolvable, but I'm just saying it's a clear area of concern. So my second point is just a more general comment around age 75 and that cliff edge. And so basically, tax-free potentially before 75 for a lot of benefits and taxable after. And it's just an open question, which is, does this age make sense? I couldn't find anything in legislation which said specifically, why is it 75? Why is it not state pension age? Why is it not a different age? My personal view is I do think there should be some sort of tax break for someone who dies early. And I think actually that is appropriate. We actually already do that in some cases of serious ill health. And I think it's right for us as a society and legislation to acknowledge that if you've saved all your life in the hope of a good retirement and then you die early, there should be some sort of tax break for your beneficiaries. But what this is going to mean from a planning perspective is that I think tactically we're going to have a look much closer at an individual and their spouse's lifetime tax rate, and in our cash flow models, really have a look very closely on the difference between lifetime and legacy expected taxes. For example, if you leave a £600,000 pension pot after age 75 to your spouse, and let's say they've maybe already got a defined benefit scheme, which isn't uncommon, it may be very difficult for them to draw out much money out of this without getting hammered for 40% rate of tax or above. So this has changed the nature of some tactics for withdrawals in my view. I just want to acknowledge that bringing the pensions into an estate hammers unmarried or cohabiting individuals or divorced individuals or single people if you've got kids or beneficiaries you want to leave benefits to. Because what that will mean is that if you've got a child and you want to leave them above £500,000, including your house, if you're single, you're going to pay inheritance. And knowing how much someone generally needs in a pension pot for a good retirement, it does feel like you can have, a reasonable property value or a comfortable pension pot, but not both without inheritance tax. So it does highlight the importance of a drawdown strategy. It's frustrating that successive governments have done nothing to resolve the big elephant in the room, which is care, social care. And now that the care cap has been effectively scrapped, I think we are putting people in a very difficult position from a planning perspective, because you have either got under-preparing yourself for home adaptations, the need of social care in later life, but also if you leave too much money, getting hit very hard for inheritance tax. It feels like there needs to be something done to help people plan for that. And finally, this is my spiciest take, and this is just my opinion, but I'm going to call out something which I think is unfair, and the cynic in me would maybe push a bit harder than that. Under the current consultation, defined benefit scheme pensions are not in the estate for inheritance tax. So that, just to recap, that is everyone in the NHS, police, and yes, politicians, annuities for dependents are. So for plebs like me in the private sector, if I went out with my pot and bought an annuity, a guaranteed income for life, the same type of thing as a defined benefit scheme, and I inbuilt it with a spousal provision, then somehow that's in the estate, but yet these public service pensions and other defined benefit schemes are not. That seems unfair, and I can't really justify that. They haven't specified exactly how they're going to include that dependence annuity calculation in the estate. But for me, I think we should call it out. That seems biased towards public sector workers at the expense of people in the private sector. And as let's be honest, it's the people in the public sector who make the rules. I think it's fair to feel aggrieved by that. So what do you think of the proposals? Please do let me know in the comments. In the next video on the budget, I'm actually going to go over some real tactics that I've been thinking about since the budget, about what I'm going to be using with my clients to make the best of the changes. Thanks so much for watching.